In the year 1720, Paris wasn't panicking, it was euphoric. The streets were louder than usual, cafes were overflowing, and ordinary people believed they were living through the beginning of a new financial era. This wasn't desperation. This was confidence. France had spent years buried under war debt, taxes were crushing the population, and the economy was suffocating under the limits of gold and silver. Everyday life for most people was a struggle. Bread was expensive, the cost of living was rising, and the government seemed incapable of relieving the burden. And then a man named John Law arrived with an idea that sounded almost too logical to question. Law claimed that money didn't need to be scarce. Wealth didn't need to be slow. If value could be represented on paper instead of locked in metal, the economy could finally breathe. Growth could accelerate. Everyone could win. It was revolutionary, seductive, and impossible simple. He convinced the French government to let him run the national bank, and suddenly the impossible seemed plausible. Paper money replaced gold, credit expanded, and to give this new system something tangible to believe in, shares were issued in a company that supposedly controlled enormous resource-rich land in Louisiana. On paper, this land was the future of France's wealth. In reality, almost no one had ever seen it. But that didn't matter. Prices rose anyway, not because production increased, not because profits existed, but because belief spread faster than doubt. The people of Paris didn't just invest. They abandoned caution entirely. They sold homes, businesses, family heirlooms. The obsession was total. Wealth wasn't being earned anymore. It was being assumed. Ordinary clerks became overnight millionaires. Artisans, bakers, shopkeepers, even street performers believed that by holding a few shares, they could escape the grinding reality of their daily lives. Cafes were filled with whispers of fortunes made and promises of riches just around the corner. Even the skeptics were drowned out by the roar of optimism. For a time, the illusion held. Share prices multiplied, sometimes doubling in a matter of weeks. Fortunes appeared overnight. Anyone who questioned the system was dismissed as outdated, fearful, or unenlightened. This, they said, was modern finance. Old rules no longer applied. But beneath the glittering excitement, the foundation was hollow. The land was mostly swamp. Trade was minimal. Profits were a mirage. The system relied entirely on new money flowing in to support rising prices. And when people finally tried to convert their paper wealth back into gold, the truth surfaced. Quietly, then violently. There wasn't enough gold to satisfy the illusion. Confidence vanished faster than it appeared. Within months, prices collapsed. Wealth evaporated. The same people who had felt invincible discovered they were expendable. Insiders exited early. Everyone else absorbed the damage. Lives were ruined. Families lost homes. Businesses went under. Dreams turned to dust. History is littered with these moments, and yet humans are remarkably eager to repeat them. That story sounds like ancient history, disconnected from our modern lives, but the structure of it is happening again. Only this time, it's dressed in new language, better graphics, and cleaner charts. Today, instead of Louisiana swampland, it's a small group of massive tech companies. Instead of paper money, it's passive index funds. And instead of one charismatic banker selling the dream, it's an entire financial industry repeating the same promise. Buy, hold, and don't ask questions. It feels responsible because it's boring. It feels safe because everyone agrees. But safety isn't defined by popularity, it's defined by how fragile a system becomes when conditions change. Consider the 1970s. Investors were told the Nifty 50 were untouchable. Companies so dominant they could be bought at any price and held forever. It was an era of unquestioning optimism. People believed these companies were impervious to economic cycles, recession, or any of the usual risks. And then inflation surged, growth slowed. Suddenly those safe stocks fell by as much as 90%, trapping investors for decades. Or the late 1990s, when technology was considered unstoppable. The promise of the new economy convinced investors that traditional valuation rules no longer applied. Stocks soared on hype and optimism alone. Then the bubble burst, jobs disappeared, savings evaporated, and millions learned a bitter lesson about the illusion of permanence. And of course, the 2007 housing market collapse was another repeat of the same pattern. Homes always appreciated, everyone said, until they didn't. Millions of people lost their homes, their retirement funds, their sense of security. Each cycle looks different, but the underlying error is identical, confusing concentration for security and assuming that recent success will continue indefinitely. This pattern isn't just financial, it's human. We want to believe in something permanent, something stable, because uncertainty is uncomfortable. But the markets aren't a place for comfort. They are a mirror for risk. Fast forward to 2026, and the uncomfortable truth remains. Most investors believe they're diversified when they're not. A massive portion of their wealth depends on a handful of companies remaining dominant, perfectly priced, and politically protected forever. As long as markets rise, nobody questions it. But markets don't reward belief. They reprice risk, and when that happens, losses aren't abstract. They're tangible. They're postponed retirements, forced career changes, and years of life quietly taken away. They're the sleepless nights spent watching numbers drop, and the anxiety of realizing that your financial safety net isn't as strong as you thought. And it's not just the people investing. Entire governments, pension funds, and institutions are caught in the same web. They assume stability because the system looks orderly, because everyone else is participating, and because the rules they've relied on seem permanent. But as John Law showed 300 years ago, the strength of a system isn't measured by the speed of its rise. It's measured by its ability to withstand the collapse that eventually comes. This isn't about predicting an imminent crash. It's not about scaring you into thinking everything will fall apart tomorrow. It's about recognizing patterns, seeing the fragility before it's tested. Because the people who survive these moments aren't those chasing maximum upside. They're the ones who quietly reduced risk, who prepared while others celebrated, who understood that what feels safe isn't always safe. It's simply unquestioned. The lesson of Paris, of the Nifty 50, of tech bubbles and housing crises, is simple but often ignored. Confidence is contagious, but risk is real. Systems built on belief alone always look strongest right before they break. And when that break comes, it doesn't just take money, it takes time, security, peace of mind, and trust in the world you thought was stable. So the question isn't whether markets will fall. The question is whether your plan, your investments, your assumptions, and your belief in permanence are strong enough to survive the moment everyone else finally realizes the truth. Because the cost of being late, of assuming safety without proof, is measured not in paper losses. It's measured in lost years, lost opportunities, and the quiet erosion of everything you hope to protect. In the end, history isn't just a record of what happened. It's a warning, and the people who learn from it are the ones who don't just survive the next bubble. They thrive quietly while everyone else is still chasing the illusion.